he talks about potential supply shocks. Everybody's still watching the tariffs. Walmart was talking about price hikes. Retail sales barely rose last month. And yet the bias from these same people that I'm speaking with continues to be, you know what, stocks can still go up. Stocks can still go up from here for a while.
I think we just got a CPI report that might be the last of the tame CPI reports. But I also think some of the weirdness that we'll see when we get the May number, for example, in the middle of June, will be the type of weirdness that the market has historically looked through. So we're going to have these like supply shocks for specific materials in certain industries. It'll be colored with anecdotal things alongside of the data. And the market's going to look at that and say, yeah, that's not great, but it's also not systemic rising inflation. It's not the fall of 2021. And the Fed probably isn't going to be put in a position where they have to act on it. The Fed doesn't actually cause that type of inflation. The tariffs cause that type of inflation, and everyone knows it. And the Fed obviously can't fix it either. So that's where I land as far as like, is that the thing that the market has to worry about next? I actually don't think tariffs are inflationary in the fullness of time. Let's assume this 30% on China stays. And by the way, with a tweet, it could be gone tomorrow. But just hypothetically, I actually think that's a demand destruction machine. And I think that ultimately you don't get incredibly high inflation as a result of that. You actually get disinflation eventually once you have those aberrant prints in the numbers themselves. So just looking at what we got, for example, on PPI, lower than expected. Month-over-month decline in trade services was the big reason why. Negative 0.5 month-over-month, so sequential, not year-over-year. Trade services dropped 1.6%. So when you understand the bigger picture, which is that we don't have companies fighting for talent, we don't have these incredibly rising rents or wages or used car prices or some of the things that were the leading drivers of the inflation problem we just survived, and it's just this kind of trade war uncertainty, you realize this is not going to be a monster issue for the markets longer term. It might produce some scary days, but I just don't think that's the big problem right now.
Joe, you know, the tariffs, if anything, they scared consumers and are scaring consumers into changing their buying decisions. They bought, we learned from retail sales, which barely rose, but they did rise in March. Why? Because people front ran what they thought the tariffs were going to be. And now on top of that, you're going to raise prices, Walmart. And what do you think that's going to do, to Josh's point, to demand? Because Walmart today said that their price hikes could start later this month, despite the deal with China. You own Walmart.
I do. I thought the eco data today was the beginning of what we've been talking about, which is the deceleration in demand, a cooling for the economy. And I agree with Josh. I don't know necessarily that the casualty of persistent tariffs is a spike of inflation. I actually think it's margin compression for corporations, and the risk is to the earnings outlook. And I think we saw that and heard that today from Walmart. Look, I said yesterday, I think Walmart's a $1 trillion company at some point. I believe it's a core holding. There was a lot of positive that was idiosyncratic to Walmart. E-commerce, very strong. Okay, you had both revenue and profitability that was present in this quarter. The problem was the commentary, which was different than what we heard at the Analyst Day. The Analyst Day, we kind of heard, well, okay, we're going to absorb a lot of the tariff cost. We didn't hear that today. Today we heard, well, guess what? Over the next month, prices are going to begin to rise. That was much different. So I think that rattled shareholders. Absolutely, I'm maintaining my position because I think they have market share, and it's got the right type of market share to have in an economic environment that I think we're looking at in the next 90 days, which is one where demand declines.
Okay, so that sort of sets the scene for the market, okay? The S&P, Jenny, is up more than 18% from its closing low on April 8th. 25-day trading period. The index has only done that 5 other times going back to 1970. That big of a gain in that short of time. Where do we go from here? Do we have the momentum to continue to go higher? We are but 4+% from a new high on the S&P. For somebody who's been kind of cautious on the overall environment, Haven't heard from you, I don't think, since last weekend's agreement to roll back the tariffs. What do you think now?
So I'm more uncomfortable now than I was even last week.
How's that possible?
Exactly because of what you laid out. When everybody's positive, when everything looks good, that's when things might not be, when you might have topped out. So we're trading at 21 times. However you cut it, tariffs have brought more uncertainty into our world, right? Supply chains are messed up, and all the good numbers that we just saw come out in earnings, those are all reflective of a world order that's stale. Right? That's 3 months ago. That world order is stale. Things are changing. And so I don't know what lies ahead right now. I don't know what's happening with interest rates. I don't know if we're going to be at 5% on the 10-year or 4%. I don't know what inflation's really going to do. Like, we can speculate, but we really don't know. So when you have higher than average rates that we're at and massive uncertainty, that to me does not support 21 times. But then when you ask me, like, what do I do? Well, here's the irony, maybe. I'm still fully invested, but I'm comfortable with my portfolio because it trades at about 13.5 times. It pumps out a 5% plus dividend yield. So that brings me comfort because that's more certain and less risky on a valuation perspective than the broader market. And that's for me a hard thing to reconcile. Like, how am I uncomfortable with the broader market, but comfortable with what I'm in? But I don't love this market.
I don't see how you can be more negative today than you were last week, just given the
I don't like that the
rollback,
market's up so much.
The rollback of that's a fair statement, by the way. I mean, the market is up a lot. Some suggest maybe too much. I mean, Steve Cohen yesterday at the Sohn conference said stocks could retest their April lows and still sees a 45% chance of recession. He also said, when he was answering the same question, if you would have asked him a week ago, he might have given a different answer, kind of to my point. The trading environment seemed far different a week ago than it does today. Does it not?
Yeah, today.
Despite the move in the market.
Today it just seems like a nonsensical return to the AI trade. Right, to what we had all of kind of 2024. It just seems like people have thrown out the fact that there are real risks, that it is a different world, and they're saying, like, hey, let's just go back to what worked. I was listening to...
Is it nonsensical, though? Those are the companies that comprise the bulk of the market cap in the S&P, and they had stellar, not only earnings reports, but spending guidance.
They did.
They did, with the exception of Alphabet and Tesla. They
hold
did.
On. All right, let me rephrase. They didn't have stellar earnings reports, given where some of their multiples are.
Oh,
right?
well,
And that's...
Wait. Don't
given the fact that it was Wednesday, I mean...
Something big happened this week, and don't lose sight of it, all right? Saudi Arabia, Humane, the company that the Sovereign Wealth Fund is putting together there, the spending that they're going to be doing on AI is actually tremendous. And I'm not somebody who drinks Kool-Aid, all right? We'll talk about Cisco later, but I listened to the conference call last night, and I can tell you it's not just Cisco, it's Cisco talking about working with NVIDIA, working with others on hundreds of billions of dollars of incremental spending on AI, on data centers in Saudi Arabia. And let's just face it, we weren't talking about that a week ago. It just wasn't anywhere on anybody's radar.
No, but didn't we
you
just
need to believe it's 100% true.
But
Sorry,
we just
It is true, Jenny. It's true.
We recalibrated back to the consensus expectation coming into the year for tariffs.
Fair enough.
30% was the number. Coming into the year, everyone said, okay, the rate for China will be 30%. We're back to 30%. So why shouldn't we?
Meta came out and confirmed its spending plans for the year. So did Microsoft. And the big thing that you don't have is the reason to say this rally is a false rally, and it still might turn out to be. The Qs went up 25%, the S&P went up 18%. So for those keeping score, a 25% rally in the Nasdaq is an incredible rally, and it doesn't happen randomly. It happens because of those earnings results. Now, what could be the monkey wrench is if all of a sudden you start getting disappointments on the employment data. I think that's the bigger risk than inflation, than interest rates. The unemployment data so far is not falling apart, and so long as people have jobs, this thing can continue to levitate. It's very frustrating. I was as bearish as anyone on this desk in April, and then you know what happened? Meta comes out, Microsoft comes out, even Apple comes out. It's just not as bad as people thought it would
Josh,
be
do you
today.
think
You got an initial claims number today of 229,000. Right on the number as far as what the estimates were.
And do you think, I'm asking this literally, do you think companies really want to let people go right now when the trade policy uncertainty, which you've pointed out, Jenny, is coming down? I think this is the point where companies are saying it could get a lot brighter. The fog, we talked about the fog, Scott. If the fog is lifting, companies want to have their employees in place. They don't want to let people go now.
There was a big scary headline on CNBC.com and elsewhere about Microsoft's mass layoffs. Dude, they're laying off 6,000 people, 3% of their workforce. It was this huge splashy headline everywhere. Goldman Sachs lays off 3% of its people every year. Like, the unemployment situation has not changed. And from my perspective, if we say we're in a consumer-driven economy, if we say the consumer is 70% of GDP, and that part of it is holding up. Yes, I know there's trade downs. I know the lower income are more pressured by higher I understand all these things. Tell me when we get a shock to the labor market, and I'll tell you when it's time to start saying all of these expectations are going to fall apart.
To get back to where you think the market should be, to get there,
what if we are where it is?
No, you're not there, because sentiment is not aligned with where price is, nor is positioning. And that's why the NASDAQ's up 25%, because the NASDAQ was the casualty of the market selling that we saw earlier. Everyone moved to the sidelines in those names. Now you're rebuilding positions. You're gradually getting sentiment up to where it needs to be. For you to realize the reality of where you think the market is, we've got to be sitting on the desk and we say, okay, now positioning's full. Sentiment is overwhelmingly bullish. No one believes we're going back to the place we were in early April. And then you get your moment.
I hear you, but I think you guys are all presuming that me not being bullish means that I think the market's going down 10 or 15%.
I'm not bullish. I think we're in a range. So I'm with you.
The question was, how does the rally go higher? How does it continue more? Higher.
My question back to you was, I don't see how you can make a case today that we're worse off than we were a week ago. When tariffs have come down as significantly as they have. You can be annoyed at the process. I get we're in such a politically polarized universe.
But the worse off is on valuation. How do you go from 21 times to 23 times?
But last week, but a month ago, you would have said that earnings are not going to be good. We're not going to get any guidance. There's no way that. That wasn't. It turned out not to be right.
Correct.
That's my point.
Okay.
Guidance was way better than people thought, including you. Earnings were way better than people thought, including you.
No, I thought earnings would come in as expected because that was already baked in.
No, they were better than expected. They were better than expected.
No. Fine, but we're still at what, 11% earnings growth year over year? I don't get how we go from a 21 times multiple to a 23 times, because I still don't think fundamentally the world is better off before it was before April 2nd. That's my problem.
Why is it necessary for us to get to 23 times earnings?
Because how else do you go up 10%? Right? That's 10% growth. You need multiple expansion.
No, if you have earnings growth.
The earnings growth is already baked in. That's the thing. The earnings growth is already baked in. On April 2nd, the market was down 4 and change percent. Now it's up on the year. What's different? Well, the earnings growth came in to still put us on track for the 11%, 12% earnings growth year over year. Right? You have a multiple that's back to where it was, and I don't see the world as better now than it was before.
I don't think it's better now. I just agree with Judge that I don't think it's more uncertain. We could argue, is it less uncertain? I would say probably not. So Walmart comes in, they say we're going to maintain our full year forecast, but we're going to cut Q2. We're going to remove Q2 forecast.
And
that's not great.
No, but they're also saying the impact of the tariffs have yet to be felt, and that's why I'm saying this is reflecting a stale world order.
I think we all agree that the impact of the tariffs have not been felt.
Right.
I think every one of us agrees with that.
So that's uncertain, and we have no idea what it's really going to feel like.
It's coming now. But listen, you had dispersion in the earnings. It wasn't isolated to technology and communication services. And here's the interesting part. So Josh said he's not bullish, and obviously I think we're going to make a run at the all-time high. I think that's what momentum is telling you. But here's what's interesting about that. I was asked this on a call yesterday. Well, what happens next?
Yeah, I agree.
Do you break out from there? I'm not so sure. I think you might be trapping people.
You know the answer.
I think you might be trapping people.
If you set a new high from here, FOMO comes in, and it comes in hard.
That might be a trap.
And you might be right, Jenny, from a fundamental point of view, but don't mistake that. You start seeing headlines of a new all-time high.
A ton of money. You know what the number one category of ETFs gaining assets last month? T-bills. So to your point, like if you start printing new highs, without a doubt, there's a component of the investor class that's underinvested.
I just feel like some of you guys and people in general are missing part of what's happening here, in that you're going to start hearing, I think, less and less about tariffs and trade, and more about taxes.
Absolutely.
And
100%.
Deregulation, and the kinds of things that are going to be a boon potentially for this market, not an anvil on the shoulders of this market.
I think you're exactly right. And you know, look, you and I usually like to argue. You want me to buy UnitedHealth right now and we can start an argument? No.
I was kind of wishing you still owned it today, but
That's so mean.
he knows I'm kidding.
I know you're not kidding.
Yeah, I don't think you are.
that is pretty show-stoppingly funny. But, you know, Scott, somebody said to me today, what if things go right? Think about this for a second. Next year's earnings estimates on the S&P 500 are $300 a share. To the point, Jenny, that you're making, I mean, we're at 20 times that. But what if things go right? What if the tax bill is stimulative? What if the Fed cuts rates? These are just what ifs. What if the tariffs are, as you were saying at the beginning of the show, a one shot, you're done, you get the price level reset, and you move on? I mean,
well, there's two things. The tariffs are so riddled with exemptions at this point. That's why I think the market will see through aberrant data in the next set of CPI, PPI prints, because almost everything is exempt, it almost doesn't matter. If iPhones are exempt, like, what do people spend money on? If we start doing carve-outs for automakers, I don't think that's the story. The story is the slowdown for real. Goldman Sachs was saying, we think we'll see 4.7% unemployment. Then there's a deal on Saturday. I don't even know what the deal is. Goldman comes out and says, just kidding, more like 4.5%, right? All the recession calls start getting moderated. We think there's definitely a recession. Now we think there's maybe a recession. My opinion, so long as the consumer continues to spend and so long as the consumer continues to be employed, every other data point we're following doesn't really matter. And I understand people say employment is a lagging indicator. Okay, it might be a lagging indicator, but it's literally the best indicator we have.
It's been lagging for 3 years, by the way.
Forget the recession call. So are you saying that we might escape without the growth scare over the next 3 to 6 months?
That's the thing. I don't know. How do you get a growth scare when the largest companies in the stock market are defensive? So this is the thing that people haven't. I think I'm living in the year 2030. This is and I don't like to brag about my insights that much. Sometimes I do. This is the thing that nobody has figured out yet. Do people cancel Netflix in a recession?
No.
Do people throw their iPhone in the garbage because the services cost them too much money?
No.
Do people stop any of the behaviors with Uber and Uber Eats, with Spotify? Is any of that pro-cyclical, or is the entirety of stock market market cap now defensive? Services that people will not abandon. They will stop doing almost everything else before they stop with their digital devices and the way they spend their day, scrolling through TikTok, etc. So if that's the market we're in, we might have to accept the fact that we just don't have as cyclical of a stock market anymore. The economy is still cyclical, but the stocks, we're not investing in economic conditions. We're investing in corporate profits.
Speaking of, Netflix, another all-time high today. Their ad tier now has 94 million monthly active users, reiterated outperform at Evercore and Josh Brown Capital.
That's what I'm saying, dog.
Whoa.
And so I want you to think this through with me. If people aren't canceling YouTube TV subscriptions, and they're not throwing away their iPhone because of the cost of the services, and they're not cutting off Netflix, or if they do, they downgrade from premium tier to ad-sponsored tier, and actually Netflix makes even more money in that case. If that's the makeup of the stock market, and companies like, do you remember how important Alcoa used to be?
Oh, come
on.
No,
but do you remember? Jenny, I know you remember.
That's like 1980.
20 years ago, Alcoa would report first because it started with an A. Guys, kids in the audience, I swear to God, this is real. And we used to say, as goes Alcoa, so goes because the stock market was so cyclical. Now, it's like this oligopoly of tech companies that are consumer staples.
I think you're pulling
defensive.
your punch. I think you're pulling your punch. Don't just talk about Uber or Netflix. Go out to a generic steakhouse in New York City on a Tuesday night.
Packed.
Tell me what, packed. I mean, and all of us go out, you know what I'm talking about. Every high-end restaurant is packed.
That's the K-shaped nature of the economy, which is a whole other discussion. But I agree.
But
I agree.
But where do the profits come from? And I'm not trying to be heartless. Where do the profits come from?
Can I ask you back to you had mentioned Cisco a little bit earlier. I just want to do a couple of things before we take our first break, because you bought more of this stock. They beat. They got upgraded to overweight at Wells. I know I took kind of a hard turn, but I want to get that in before we take our break.
So I already talked about the macro implications of it. Let's talk about the stock implications. I think the direct analogy here is Oracle. I want everybody to think about Oracle 3-4 years ago. It was a mid-teens multiple. Nobody cared too much. It was a database software company. Then they got into Oracle Cloud Infrastructure, and the stock took off. And the multiple went to the low 20s. I suggest to you, I submit to you that is what's going to happen with Cisco, and it's happening right now. It's been happening over the last year. Josh, I ask you to take a look at it. This is a stock that should be trading in the low 20s, and it's trading at about 16.5 times. It's buying back shares like crazy. It's got a good dividend. And most importantly, the fundamental drivers, they are growing their business. They are beating, raising. There's nothing negative to say about this company.
The fundamentals are remarkably strong, and what's going to happen now, we identified it at the end of April as finally becoming a quote-unquote momentum trade.
Yeah.
And you're going to see a lot of funds follow suit and begin to acquire this company based on momentum itself. We're in from April 30th. I thought the report was excellent, and there is obvious AI spend on network.
Cisco is a really great example of the point I'm trying to illustrate. The way we used to think about that stock is it's effectively a call option on GDP. If global economy is growing faster than normal, Cisco will have more orders. If the global economy is slowing, Cisco will have less orders. I think the stock, at least, has broken out of that paradigm, and they're now thinking about Cisco as, you guessed it, a more defensive version of its former self. It's no one's going to stop their internet usage.
Right.
This is the most, no business. Oh, it's an economic slowdown. Everybody used the internet 20% less. It's not going to happen.
So Cisco is the reason that I can be kind of like negative and, Debbie Downer and worried about the future, but still fully invested. So we've owned this for years in our disciplined growth strategy. The thesis has always been it's returning to a growth company, it should re-rate. But this is why I can be uncomfortable with a 21 times multiple on the market and comfortable being invested at 15 and change times here. So that's how I marry my pessimism with fully invested.
It's very infrequent that you can identify the pivot point. It's happening right now. The multiple is re-rating, and it should. It's happening right now.
And I'm so grateful we were early.
Let me move on.
Hey everybody, welcome to Blue Cloud Trading. My name is George. It's Thursday. It's May 15th. 5:15 p.m. as I'm recording this video, and we just saw a clip from today's episode of the Halftime Report where they covered Cisco, all right, and they also talked about the stock market. So we're going to look at the indices today, the S&P 500, we'll look at the Dow Jones, we'll look at Russell 2000 ETF. So before we get started, let me just show you guys what's going on in the markets here. The Dow Jones, for example, today was actually up 0.65%. NASDAQ was down 0.18%, S&P 500 was up 0.41%, and the Russell 2000 was up 0.65%. Here's the heat map, and as you can see, Amazon, Meta, Google, Apple, Microsoft, NVIDIA, Oracle, they were all down today. A lot of the technology stocks got hit today, but they were doing pretty good for the week, right? If we look at the weekly performance, they were very much in the green, as you can see. So, but today they took a breather, giving the other sectors an opportunity to thrive here. Like the utilities got very bullish today, and so did the healthcare stocks. Consumer defensives, we got financials did well, and yeah, even basic materials. Let's look at the sector rotation here. This shows us the individual sectors, the one-day performance. You'll see utilities was up the most, consumer defensive, real estate, and healthcare. And then the ones down were consumer cyclical and technology. But for the week, technology was the number one performer, up 7.6%, and healthcare was down 1.88%. What we're going to do, one more thing I want to just show you guys. So yeah, Wall Street ends mixed. Cisco rallies while UnitedHealth tumbles. I'm going to show you that chart in a few seconds. Yeah, basically UnitedHealth down on report. It faces criminal probe. So that is never a good thing for a company to hear. And so let's take a look at Cisco first, and then we'll look at UNH, and then we'll run into the indices. So let's start off with Cisco because, as you can see, it was up 4.85%. It actually gapped up today. And but what happened towards the end of the day is interesting as well. If you take a close look here, you'll notice this is a Japanese candlestick, and you'll notice this long wick. And what that represents is how high the price got today before finally closing at this level at 4 p.m., all right, at 64.26. So, yeah, you can see the price gapped up, moved up to that level, and then a lot of selling started taking place in the afternoon. We can see all of that, of course, by just switching it to a 5-minute chart. So let me do that. And let's take a look at that. So there's that gap up. Here it is. Here we are on the 15th. Price moved up. And then basically from that point on, probably around this point right here, at approximately 11:20 a.m., Cisco dropped about 1.42%. So it's interesting that, that was the trigger was price actually closing under the Tenkan-sen. Now, the Tenkan-sen is actually the green line there is the 9-period moving average. The red line is the 26-period. And then you've got the Ichimoku cloud that we're using here. Whenever you see price getting under the moving averages, this tends to get a little bit bearish. So you have to be really cautious when maybe that's the time to take some profits, okay? But basically, let's look at this on the weekly chart too. I'm just kind of curious. So you can see that we're getting closer and closer now to that 66.50 level. Why is that an important level? Because it's basically the all-time highs of 66.50. That took place right here on February 14th, 2025. Since that point, once it reached that level, price dropped. Many times what you'll notice and see in the markets is price coming back to a prior level, a prior high, and then getting sold off again. If, however, we get to that level in the next, tomorrow, the next day, tomorrow, Monday, Tuesday, next week, or whatever, and we break through that 66.50 level, we could certainly see a continuation. But yeah, today's this candle here tends to be a little bit more bearish than bullish because of that long wick at the top. All right, and let's look at UNH too, because UNH is got hit hard. It was down 10.93% just today. This is the daily chart we're looking at. So you can see that everything started to fall apart right here on this specific day back on April 17th, just about a month ago or so. Price from that level gapped down about approximately 17.9%, and then finally by the end of the day, it closed about down 22%. How far has it dropped now? Right now, the closing, it's down about, let's see, 52.9%. That's a huge drop in just 29 days. So this is where technical analysis can come in handy, basically. This is why I kind of preach why it's so important to always check to see where price is in relation to the Ichimoku cloud. When price gets under, there's a good reason, typically. It's a news event. Maybe it's the earnings event. Maybe the CEO just quit, It could be any type of reason, and then you'll notice it in the price gaps down, and as you can see, the stock is out of favor. Consistent selling, day after day after day of selling, dropping more and more, and now they even got that that the negative news that you just heard about, that I just talked about. So we can also switch this over to a 2-hour time frame. So if you want to see what this looks like on a shorter time frame, let's look at that. Again, this is basically that April 17th date. Even on the 2-hour time frame, it got under that dotted yellow line. There's the 200-day simple moving average. It got under that level and then just continue to drop. So there is an advantage to utilizing technical analysis, and using this indicator, in my opinion, is one of the easiest ones. I know it looks a little bit complicated with all these lines and everything, but in reality, it's actually probably one of the simplest indicators, because all you need to do is see where price is in relation to where the cloud is. If price is under the cloud, okay, this is bearish territory. If price is above, it's bullish, okay? And price tends to rise when price is above the Ichimoku cloud. All the technical analysts are watching this. If you go back here and you measure when price popped above the Ichimoku cloud, for example, right here, and we measured that move in approximately, let's see, 25 days, it was up 21.3%. So yeah, UNH, I mean, man, what a downfall, right? It went from like around $630, right, at these highs back here in 2024 down to $274.29. This is why it's never a great idea to just say, you know what, I'm going to buy a stock and hold it forever, okay? Because this stock may not come back, folks. It may not come back. There have been other stocks. Just I'll give you an example. Another one, Roku, for example. Here's one going back to 2025, where price was around $106 back in on February 14th of 2025, and it actually dropped from that level 49.35% in just 1.7 months. To get back to that same level, you need to make about a 97% return. Okay, that could take a very long time, and your money could be tied up for quite a long time. So this is why it's important to also, in addition to looking at fundamentals, utilize the technicals. It can help with the timing. I know some people say, "Oh, there's no such thing as market timing." There is. There are times to enter a stock, and there's times to get out. And this helps give us a bit of a clue of when it's the appropriate time to get out. It's better to take small losses versus much more significant losses over a very, very long period of time. So, all right, let's look at the Dow Jones now. Here's the 2-hour on the Dow. Okay, you can see here on this specific day back on April 23rd is when it popped. Right, it popped above the Ichimoku cloud, came back down, found some support, and then continued on, and it has moved up about from this point about 6%, 6.26%. Here's the daily time frame. Just recently, we broke through that Ichimoku cloud on the daily. So one other important thing I'd mention is you also have to determine what type of trader you are. Are you someone that has the time to be looking at the stocks, at least once a day, your portfolio? If that's the case, you could use the daily time frame. If you don't have that time, maybe you switch it to the weekly chart. I'll just switch it real quick to the weekly. So you can see here that we are popping above the Ichimoku cloud on the weekly chart. So that's giving us a little bit more optimism that this has a potential to continue to move up. Not all of the elements of the Ichimoku are bullish right now. We still have the Tenkan-sen, the faster moving average is still under the slower one, the 26 period. And the Chiku span, that white line that you see there, is still under the candle 26 periods ago. So all you need to do is look to see where this closing price was here. You project it 26 periods back. That's where you'll always find that the end of the white line. That's the closing price right there. So if that is under the candle, that's typically telling us, hey, we don't have a really strong trend here. And in fact, it's kind of obvious because all you need to do is just look at this chart and you can see just, general analysis. If you look to see, for example, that, okay, here's a prior low and you can see where the Dow was, right? The Dow broke this on the weekly chart and closed. Once it got under that low, it continued to drop a bit. Now the good news is it's actually getting above that level again. This is the first week. That little candle right there, popping through that low. You can see that right there for the first time. So this is giving us a little bit more bullishness. There's more possibilities here, more bullish possibilities for the Dow. All right. Again, daily time frame, and then here's the 2-hour. So that's looking good. Let's look at the FEZ. This is the Euro Stoxx 50. And this one on the daily chart still looks very bullish. In this case, all of the elements of Ichimoku are giving us a buy signal. We've got a bullish cloud with Senko span A above the Senko span B. That's the light colored blue line there above the purple one. We've got the green line Tenkan-sen above the Kijun-sen, the slower red line. That's bullish. We've got the closing price here 26 periods ago. As you can see, the Chiku span, they call that the Chiku span. That's above the candle 26 periods ago. That's all you need to see. If you see all that, it's telling us that it's a very bullish trend. We have that also on the weekly chart. So we got that bullish cloud right there. Tenkan-sen above the Kijun-sen. Chiku span above price. What about the 2-hour? same thing. So you've got 3 time frames giving you confirmation. You've got the weekly, you get the daily, and you got the 2-hour. And you just saw how quickly I was able to assess that. That's the beauty of this indicator, because Ichimoku in Japanese basically stands for at a glance. And so what you don't want to do is get tied up in trying to overanalyze a chart. This, because of the rules of the indicator, it helps to quickly assess the situation. All right. So now now that you know all the rules about Ichimoku, we can continue going through all of these, and we won't really need to spend too much time. Okay. So here's the Russell 2000, also right above the Ichimoku cloud right now. That's very good. It has not taken out this prior high though, the 209.27 yet. Okay, so that's something that needs to take place, in my opinion, before. And you also have resistance at that 200-day moving average, about 3.6% away from where we currently are. So I'd be watching for that. The QQQ ETF is still moving up. It's got potential here to continue moving to the 540 level, another 3.9% before it reaches that level of resistance. That could be a target, for example. All right. When you see price, however, getting a little bit more extended above the moving averages, just remember it's more than likely to pull back at some point to the Tenkan-sen, for example, which is the 9 period, just like it did right here. Okay, it just tends to do that. Like it's like a magnet, and it will come back to it. So just, but then it may also just bounce and continue its move up. Here's the S&P 500, also looking pretty strong. We've got a bullish engulfing pattern right there, those 2 candles. We've talked about that before. And I'll just pop it up real quick. Here it is right here, this bullish engulfing pattern right there. So what you're looking at is this small little red candle, and it's followed by a larger bullish candle that completely engulfs it. That is a bullish double candle pattern. The opposite would be the bearish engulfing. It's when you have a small bullish candle followed by a large red candle that engulfs it. And if you guys like this little candle pattern reference sheet, you can find it on my Twitter page. All you need to do is go to, this is my handle on x.com. It's at Blue Cloud Trader. And where, the place to find this along would be right here. Under the highlights section, click on that, scroll down a little bit. There it is. Okay. From here, it's easy. You can actually download it by clicking this little, or bookmark it or whatever. I think there's a way to download it too. And then there's also this pattern cheat sheet that you might find useful. And while you're there, why not hit that follow button or whatever so that you can follow me. I do post news articles and stuff throughout the day, usually. Things that are taking place, and sometimes I'll post basically S&P 500 maps like this. All right. Anyway, let's get back to what we were talking about here. So S&P 500 is looking strong. I mean, it's also taking out that prior April 2nd date, that very important date, right? So there's a continuation taking place. Here's a 2-hour time frame, very strong uptrend on the SPY. The thing is it starting to get extended? It is, and so we always have to keep that in mind. Whenever a trend starts moving for this long, right? Since we're talking about now since April 23rd, this trend has been extremely strong and continuing to move up. We have to just recognize that it might slow down. It might start going sideways. It might pull back a little bit, but overall it's looking good. Now the VIX, this is the volatility index. Let's look at the daily one on this one. Okay. So it was down 4.24%. This represents the volatility in the markets and fear, basically. The good news is the VIX is currently under the 200-day moving average, that yellow dotted line there. So you can see right there, it closed now for a 4th day under that level, and it's just at a level of 17.83, which is good. This is what we want to see. We want to see the VIX dropping, and it's the inverse reaction. You'll have that inverse reaction in the stock market. All right, let's take a look next at the Mag 7 stocks. If you guys like the content that I'm bringing you, consider becoming a member of the channel. To do that, right next to the subscribe button, what you'll find here is a join button, okay? And basically what you want to do is just click on that little button, and then here's what will happen. It will pop up this little screen that you see here, membership. There are 3 tiers. Blue Cloud supporter, you'd be helping to support the channel so I can continue bringing these videos to you guys. Or you can select Blue Cloud Trader level membership. This is where you'll also get access to the exclusive member only videos. And in addition to that, we've got one more level, the Blue Cloud Legend level membership. If you click on that one, you'll get those exclusive member only videos. You'll also access some of the day trading videos that I have, as well as daily trade updates, which I post. I'll show you guys where those are posted. Once you become a member, okay, there's going to be a new tab that pops up over here. It's going to show up as membership. You'll see that pop up. And this is where you would click to see those daily trades that I place. If you want to find the member only videos, all you need to do is just kind of scroll down and you'll find it right there, the second row, okay? And here are all the videos. And I do 1 video per week. Every weekend, I go over the entire portfolio of my stocks. I basically share why I entered new long positions, why I closed out of positions, and go a little bit more in depth. Usually the videos are anywhere between 40 minutes to an hour long, as you can see here. And what else? The other thing, if you haven't subscribed yet, consider subscribing. It's really easy. Just hit that subscribe button, the notification bell. Consider sharing this video with someone. And if you like the software that I use here, this TC2000 software, very easy to access this software. Again, all you need to do is click on the following. See right here it says and 9 more links. Click that. Scroll down. It's the 3rd link down right there. $25 coupon. There's also a Patreon link right there. But if you click on this right here, tc2000.com/download/Blue Cloud Trading. All right, this is where you can find, this is how you can get access to the software. You enter your email here, and you'll get a $25 coupon towards this service. It can run on Windows. You can run it on Mac too. Basically, here's the pricing. Click up here in the pricing section. Hit software plans and data. And if we go to monthly, you can see what the prices are here. Silver, gold, and platinum. I would recommend that you go with the gold. It's got the most, well, it doesn't have the most features, but it does have the majority of the features you're going to want, like tracking over 100 alerts on stocks. You can also draw on the charts. You can, there's a lot of things that you can do here. You can look at the pre-post market mode with morning pre-buzz. That's an important one if you're day trading. You can drill down through the sectors and industries. That's an important one. I do that in my weekend analysis every weekend, so you can kind of see how I go through the different sectors and the industries. It's a really good, great little feature to go through. In fact, I want to just show you guys what that drill down looks like. All right, so this is what it would look like right here. Let's say that I select financial. Here's the drill down. Here's the sectors. Here are the industries that fall under. Okay, here are the industries that fall under each sector. So if I click on financial services, you can see that banks, insurance, all these things that pop up here. All right, and then let's say hypothetically I click on this, Banks Global. On the right-hand side here, you'll see all the Banks Global that pop up, right? So these are all Bank Global stocks. There's about 27 items right there, for example. All right, let's say I switch it to insurance. Boom. Okay. You can also throw in a little chart in here. You can utilize the this specific layout that I currently use is really easy to access. Going back real quick, sorry, right here, where it says, yeah, right there, TC2000 Blue Cloud layout video. Or if you want to, yeah, right from there. Oh, this one right here, sorry, TC2000 chart layout automatic. Once you have TC2000, if you can actually just click this, all right, and this is what will pop up. This is you can import the chart template, all right, from Blue Cloud Trading. Basically, you'll have the 8 indicators and 3 panes like you see right here. All right, let's go back to what I was just talking about. So under this section here, you can see how you can switch it to different sectors like consumer defensives, and here you can see the beverages and education and all these things that pop up. Real estate, okay, real estate general. Maybe you want to look at healthcare facilities, real estate healthcare facilities. That's what will pop up here on these different stocks that you see. It's really cool. You can move these screens around. You can add the fundamentals or whatever other things you want to add up here on the top of the chart. You get to choose. That's the best part. So you can like choose whatever you want. So all you have to do, I think, is right click, hit add a field. Okay. And you can see all the different things that you could add. You could add the fundamentals like beta, capitalization, debt to equity ratio, all these different things, gross margins. Look at all the options. Tons. Maybe you want to look at specific types of candles like a doji star or a candle abandoned baby or tweezer bottoms, all these different things. Maybe you can want to use the money stream. That's one of their proprietary indicators that they use, TC2000. All right, this is just a lot. There's a lot. So there's so much to learn with this, and there's so much to do. So if you do like it, consider becoming number one. Consider becoming a member. Consider, downloading the software so you can access it. Maybe use the layout that I'm using here. It might be helpful. And thanks for watching, guys. I appreciate all of you who have become members, and have a great rest of the day.